Alright everybody, so welcome to today's new YouTube video. Today we will be talking about liquidity within the ICT realm and how you can use these concepts to better define your trades and become a better trader. So let's get right into it because I don't want to waste any time today. So we all know of ICT and its concepts. Everybody knows it if you're in the trading space. So regardless of how you actually feel about them, the thing is true is that they work. So we have to put our biases to the side and understand that these theories, they work in the market, and it's been back tested and proven that they work. So I know that ICT makes it very hard to understand at certain times, but we have to understand that the hard work pays off, and we're going to keep it simple, stupid. This is another thing that I like. Let's kiss. We're not going to actually kiss, right? But let's keep it simple, okay? So understanding liquidity is very crucial for profitability if you want in the markets. It is how you understand the moves of the market and gain the insight on the future of price movement. So gain the insight on how to predict market, but we're not trying to predict the market. We're trying to observe and see what the market is telling us. So liquidity is what actually moves the market. Liquidity is one of the backbones of ICT concepts. Without liquidity, you do not have ICT concepts. They form every trade idea and every single bias. It's key to comprehending institutional trading behavior and the market structure within. So that is our introduction, and now let's get right into it. So what is liquidity? So in ICT, liquidity is areas on a chart, typically above resistance or below support, where clusters of stop orders reside, targeted by smart money to execute large orders and manipulate price movement. So smart money needs to exit their trades, and they find exits or enters on their trade where there's liquidity, because they can't just get a good fill on any price. They need a price where it is balanced and they can enter within their full orders. So smart money leverages liquidity through their high-speed algorithms, and they target areas where these retail traders, quote unquote, where their stop orders are. So below lows and highs, where they're entering the position and they're putting their stop under or below these. These algorithms execute large positions by filling the opposing orders. So the stop orders are to sell, so they buy there. This often triggers the mass stop losses for the quote-unquote retail traders. So ICT concepts aim to identify these liquidity pools and allow traders to align their algorithmic movements and institutional trading patterns for their benefit. Liquidity grabs, liquidity sweeps, sweep of liquidity, these are all the same thing. Happens when big traders push prices to trigger many stop loss orders, allowing them to fill large orders at better prices. We call this manipulation in price. So there's two types of liquidity. We have to understand this. There is external versus internal range liquidity. And these two are very important because the market only moves between 1 and 2. So external range liquidity are pools of stop orders and limit orders beyond the current trading range. So the highs and lows targeted by the institutions to initiate new trends or extend existing ones. So they use the lows and the highs to extend their positions or create new trends. So this is how trends are created. And this looks like we have external trendline liquidity. You see, this is our range right here. When we're at this point right here, we understand this is the range. We have liquidity here, potential data lows, but we have low resistance liquidity here, and price will run this liquidity. Once ran, we'll go back to the internal liquidity. Internal, let's go into that. So internal range liquidity is concentrations of orders within the current trading range, and we use this by discount and premium. This is also used by quote-unquote smart money to facilitate position building and create short-term price fluctuations or trends as we know it. So price will come back down. So let's look at the trading range. This is our trading range, and this is the internal liquidity because this is the premium right here, premium of a bearish market. Price trades up into the premium and then displaces from the internal to potential external. We don't have the rest of the chart here, but there's external liquidity, lows here, lows here, lows here, that price will sweep. So once you understand this, then we can move into the identifying the actual liquidity pools within the charts. So there are different ways to find liquidity. First of all, we want to look for clean highs and lows that traders would use as resistance and swing lows. These are good because you're looking at what could go wrong, and you're trying to form a opposing bias. So people use resistance. We're trying to look for why that could potentially be a support. And I'm just using resistance and support because it's a good way for new traders to understand this. Fair value gaps are also a good sort of liquidity. So this is internal range liquidity, is fair value gaps because they're in the range. And this also applies to the fact that we want to look for premium or discount fair value gaps because these hold more power over the opposing. recent highs and lows. So note highs and lows that haven't been ran yet. Daily 4-hour time frames. These are high power time frames because they're the higher time frame and they have more power within the lower time frame, right? So we have to understand that and apply it, because also I love to use previous day high, previous day low, previous week high, previous week low, and previous month high, previous month low, because these are good liquidity pools that once ran, we can definitely see movement off of that to base our trades. We have also intraday highs and lows. So these are daily highs and lows formed during key trading sessions. So we can look for Asia high low and London highs and lows, and we can trade these within our New York session. And also open float liquidity pools. This is a theory that ICT put out in its core content, where you determine the highest low within the specific time frames. You go 20 days back, 40 days back, and 60 days back, and you move that forward every day, and you take the highs and lows within that period, and you're looking for those to be swept. So now you know like what liquidity pools there are. Let's go into the actual application of it. So we have to remember that higher probability trades come when the high time frame and low time frame liquidity pools coincide. They come together. So we need to identify order blocks, fair value gaps on the low time frame near the high time frame liquidity. This reduces the risk of false breakouts or premature entries, because no matter if you're an ICT trader or any sort of trader, there's going to be false breakouts and premature entries. ICT traders don't guarantee that this doesn't happen. So the role of liquidity in market manipulation. So remember, these markets run the stops to fill the large institution orders by triggering the retail trader stop loss orders. It's known as sweeping liquidity to me. Many other people know it as different things. This allows big players to execute their large positions without significantly impacting the price action, because the big institutions do not want to let you know where they're really going, and they have to do this subtly. So this is known as the power of three, which we'll go into another video, but it really does apply here. So we have the accumulation of price, right? Price is moving within this range. Obviously, this is internal liquidity, right? It's a fair value gap. We get that external low right here. It is swept through. We get this internal, so we get internal high swept, low swept, and once we're here, we can see that price will definitely reach higher. Look at this reaction, this quick reaction off, and then we get the distribution. So we can see that traders had their stop losses here, and here, and here. So when price was able to move up here, it was able to quickly sell off due to liquidity, and once swept this low, there was enough stop orders here that price was able to distribute higher. So we have to understand low resistance versus high resistance liquidity runs. So a low resistance liquidity run, also known as a LR, is price movement that easily sweeps through a liquidity area with minimal opposition. So this is where, look right here, this is low resistance liquidity run. Look, so there's low resistance, there's equal highs right here, and price, as you can tell, once it sweeps through, there's no displacement lower or resistance from it. We have low resistance and sweep right through it. So we have to understand that. And high resistance liquidity run is price action that encounters significant resistance when trying to sweep one of the liquidity pools. And we're looking at this from an external point of view. And then low resistance can be from an internal point of view. So we have this external low right here. And this external low is swept. And we show minimal displacement off of the sweep, right? There's no displacement lower. Usually we want to look for a price that does not close below, but as you can see here, price closed below, but we get that quick reaction back up. And then once back down, we want to look to react from this order block here, which price reacts and sends us higher into a low resistance liquidity run. Displaces from the lows, runs through the highs. So the way to identify this is low resistance liquidity run is smooth, continuous price action, while high resistance liquidity run displays choppy, struggle-filled price action. So it's trying to find its move. But what we're seeing during this choppy-filled price action is price is actually, the smart money is entering their positions in this time. So understand that. So understand also that higher time frame analysis is crucial. It determines the overall market structure and the potential resistance liquidity levels. The key strategy here is to align trades with the path of the least resistance. So we favor low resistance liquidity runs for higher probability setups. So we're not looking for a setup within the actual low resistance liquidity run. We're looking for the high resistance liquidity run favoring the low resistance. So this is the low resistance. We're targeting that and we're entering in the high resistance. So now we're going to the actual strategies that we can use with the ICT liquidity concepts. So we want to focus on LR for our entries and target HRLR for our exits. First of all, we want to identify the high time frame bias. So we want to analyze monthly and weekly charts to determine the market direction and help frame your liquidity run on the low time frame. Now we want to look for external range liquidity. So on the low time frame, identify parts of areas in the market where stop orders are likely to cluster. Think from a trader that is trading support and resistance. Think that from their point of view, where would they have their support and resistance and where would their stops be? So this is usually above swing highs, where buy side liquidity, or swing lows for sell side liquidity. So we're looking for one of those to be swept before a move. So now you just have to sit and wait. Watch for the liquidity sweep and watch for the price action. We want to see price move quickly through these liquidity areas, triggering stop orders. And then we want to look for a sharp move in the other way. We have to stay patient during this time. It's very important to stay patient because there are lows and highs that just don't work. Price will displace through them even though we're looking for reaction. So we want to identify the reversal. Stay patient and wait for the reversal. Look for sharp displacement after the sweep, showing that smart money has filled their orders and the market is ready to reverse. From there, we can look for a CISD or a fair value gap inversion. We want to look for the PDO rate in the opposite direction to be invalid. Right? Invalidated. So we want to enter on the actual internal range. So after the sweep and the identification of a reversal, we want to look for an entry opportunity using the internal range liquidity. This is where internal comes in. This could be a retracement to a bullish or bearish order block, an inversion fair value gap, so a fair value gap getting inverse and then retracing back in as an entry, and then or a return to previous support resistance within the range. So that could be OTE or a fib retracement. So now we have to set our target. We want to aim for a high resistance liquidity run. Low resistance. I don't know why this is high resistance. This is supposed to be a low right here, which could be the opposite side of the current trading range. Equal highs, low resistance liquidity, such as like a trend line liquidity, a significant high time frame liquidity level, such as high time frame a fair value gap or high time frame like previous month high, previous month low, whatever that, and a 2 to 2.5 standard deviation move from the manipulation leg. This we'll get into another video, but standard deviations are very helpful to set your targets for. Remember here that patience is the key to all of this. Without patience and the understanding of the mind, none of this will work. We want to wait for the clear setup with multiple confluences. We don't want to wait just for the liquidity sweep. We want to wait for the liquidity sweep, the displacement, and then the internal range liquidity being filled. Remember the high time frame market context as well. So now we're going to go into practical examples because we've understood everything that's been said so far. So as you can see here, we have a 3-minute fair value gap, so a higher time frame liquidity pool. We have a low in this right here, and we have accumulation here, right? We have these highs, equal highs right here. So as we can tell, this is going to be the low resistance, right? And there is lows here and lows here. So once swept, as you can see with this wick, price came all the way down here and displaced all the way higher. So we already know that now we have our sweep of liquidity, and now we're looking for a confluence to enter. So we inverse this fair value gap. There's a fair value gap here is inversed. Nothing really happening, and we come back down into this order block. Once we're in this order block, we sweep another low. Look at this. We sweep another low, and we displace from that. So we could enter on this low sweep because we already have the bias from this sweep of liquidity and this manipulation, and we'll enter here, and we'll target up here. These are all my real trades that I've taken, right? So we take and we exit out at the equal highs. The next one, we have the relative equal lows right here. And as you can see, price is trading within here, sweeps this high, able to displace lower. And once displaced lower, we see, although closed below, we see a quick displacement higher. And there's a fair value gap right here that is inversed. And we also inverse this fair value gap. So once this fair value gap is inversed, closed above, that means closing above a fair value gap, invalidating it, inversing the fair value gap. I'm in the trade because I understand that these equal highs, where this low resistance is going to be swept after this high resistance. This is a high resistance liquidity run. So I enter here and I target equal highs, and price shoots right up because we're trying to find the path of least resistance. Here's another one. So we have previous day low. So previous day low, previous day high. Remember, these are all good confluences for our trading. So price comes within it, and we're able to look for a displacement higher. So this is our manipulation. Look, price sweeps the low, shows no displacement under it, high resistance, coming higher, inverses this fair value gap. We get a trade, and then once we're up here, we're not entering yet. We're looking for that internal range liquidity, because now this is our trading range. Right here is our trading range on our low time frame. Obviously, this is still a high time frame trading range, but we're targeting these equal highs as our low resistance liquidity run. So when price comes down into the OTE of this trading range right here and the inverse fair value gap, then I'm now looking for an entry. We get that displacement higher and a retracement back into this fair value gap along with this inverse fair value gap, and I'm in the trade, bought here. My stop loss, although it is below this order block right here, I'm really not looking for any close below this bullish candle right here. And that's what the good thing is you can get out of these trades quickly by identifying trades that are invalid. All right, and then we enter here targeting equal highs, and price again just moves cleanly right up. Last one right here. So right here we have the previous day low. This is on a higher time frame on NASDAQ. These trades are all on NASDAQ. And as you can see, we have a higher time frame fair value gap right here. We have the low, the previous day low. Price comes in, displaces from it, taps into the discount of the fair value gap, the consequent encroachment, as we discussed in the previous video, and we get that clean displacement higher. We don't see any price action just staying around here. We see the quick move up, fair value gap created, and an order block right here. This order block is tapped into, and I get my trade entry right here within this fair value gap, and I put my stop below this low. But remember, if price really inverses this, although price inversed this and closed below here, I'm still confident in my trade due to the fact that this manipulation leg was so clean. We have equal highs up here, equal, and we're going to target that for our liquidity run. And as you can see, price quickly moves higher and eventually it hits these equal highs. Yes, it takes some time, but you have to be patient with your trading. So I hope you guys can understand these liquidity concepts and are able to use the fair value gaps described in the previous video along with some of my mind mastery content, and able to really apply this within the markets, because I understand that it'll help you guys a lot and be able to refine your trading strategy to increase your win rate. So thank you for coming to this video, and I hope you guys learned something.